The year is 2025 and the UK housing market is abuzz with talk of change. The Financial Conduct Authority is considering loosening the reins on mortgage lending. These rules, put in place after the 2008 financial crisis, have been the bedrock of responsible lending. But now the FCA is contemplating whether these rules might be holding back aspiring homeowners. The UK government is eager to stimulate economic growth. Easing mortgage rules could make it easier for people to climb onto the property ladder. Lenders see an opportunity to expand their loan books. Yet some fear that history might repeat itself. The FCA is treading carefully, aware of the potential consequences. The heart of the matter lies in the affordability tests that lenders must currently use. These tests, implemented after the 2008 crisis, require lenders to assess a borrower's ability to repay their mortgage, even if interest rates were to rise significantly. Some argue they have created a barrier for creditworthy borrowers, particularly first-time buyers. The FCA's dilemma is clear. Relax the rules too much, and the UK risks a resurgence of risky lending. Keep them too tight, and homeownership remains a dream for many. The FCA's review of mortgage regulations is a societal balancing act. The mere mention of easing mortgage rules is enough to send shivers down the spines of those who remember the 2008 financial crisis. The crisis, triggered by a toxic cocktail of subprime mortgages, lax lending standards, and complex financial instruments, led to the most severe global recession since the 1930s. The UK, with its heavily leveraged housing market, was hit particularly hard. The scars of that crisis run deep. Millions lost their homes, their savings, and their livelihoods. The government was forced to bail out several banks, saddling taxpayers with a hefty bill. The crisis exposed the dangers of unchecked lending and the devastating consequences of a housing market crash. The FCA, born out of the ashes of the crisis, is tasked with preventing such a disaster from happening again. But in a world of ever-evolving financial products and a political climate hungry for economic growth, can the regulator truly safeguard against another crisis while also loosening the reins on lending? Unsurprisingly, the prospect of relaxed mortgage rules has been met with a mixed bag of reactions. For lenders, the potential easing of regulations represents a tantalizing opportunity. A less stringent regulatory environment could pave the way for increased lending, potentially translating into higher profits. The ability to offer mortgages to a wider pool of borrowers, particularly those who might have struggled to meet the current affordability criteria, is an enticing prospect for banks eager to expand their loan books. However, not all lenders are champing at the bit to loosen the reins. Some, mindful of the lessons learned from 2008, urge caution. They argue that the current regulations, while perhaps overly stringent in some cases, have played a crucial role in maintaining the stability of the UK mortgage market. Relaxing these rules too drastically, they fear, could lead to a resurgence of risky lending, potentially inflating a housing bubble that could burst with devastating consequences. The debate among lenders highlights the complex trade-offs at play. While the prospect of increased lending and greater access to homeownership is appealing, the potential for a repeat of past mistakes weighs heavily on the minds of those who witnessed the devastation of the 2008 crisis firsthand. Section 5, A Divided Kingdom, Regional Impacts of Eased Rules. The potential impact of eased mortgage rules stretches far beyond the walls of banks and building societies, reaching into the very fabric of the UK's diverse regions. While relaxing lending criteria might seem like a boon for aspiring homeowners across the board, the reality is far more nuanced. The UK housing market is not a monolith. It's a patchwork quilt of regional variations, each with its unique dynamics and challenges. In some regions, particularly those in the more affordable North and Midlands, easing mortgage rules could be a game changer. It could provide a much-needed boost to local economies by making homeownership a reality for those who have been priced out of the market. However, in London and the South East, where house prices have long outstripped wage growth, the impact of relaxed rules is less clear-cut. Critics argue that easing affordability checks in these already overheated markets could further fuel demand, pushing prices even higher and exacerbating existing inequalities. They fear that instead of helping first-time buyers, relaxed rules could end up benefiting existing homeowners and property investors, further widening the gap between the housing haves and have-nots. Section 6. Beyond mortgages, contactless payments break free. The FCA's review of mortgage rules is just one piece of a much larger puzzle. The regulator is also contemplating a range of other changes designed to modernize the UK's financial services industry and adapt to the rapidly evolving digital landscape. One such proposal involves scrapping the £100 limit on contactless card payments. Introduced in 2007 with a modest limit of £10, contactless payments have become ubiquitous in the UK. The limit has been gradually increased over the years, reaching £100 in 2021. However, with the rise of digital wallets like Apple Pay and Google Pay, which often have much higher or even no limits, the £100 cap on contactless cards has come to be seen by some as an unnecessary barrier. Proponents of scrapping the limit argue that it would simplify transactions, reduce queues, and bring the UK in line with other countries that have already embraced higher or unlimited contactless limits. However, concerns have been raised about the potential impact on spending habits and the risk of fraud. Section 7. Digital death certificates, modernizing bereavement claims. In another sign of the FCA's push towards digitalization, the regulator is considering requiring firms to accept electronic verification of death. This seemingly small change could have a significant impact on bereaved families, streamlining the often complex process of dealing with a loved one's financial affairs after they've passed away. Currently, families often face lengthy delays and bureaucratic hurdles when dealing with insurance companies, banks, and other financial institutions following a death. The need to provide physical copies of death certificates, often multiple times, can add to the stress and burden during an already difficult time. By embracing digital verification of death, the FCA aims to simplify and expedite bereavement claims, allowing families to settle their loved ones' financial affairs more efficiently. This move towards digitalization reflects a broader trend within the financial services industry as firms seek to leverage technology to improve customer experience and streamline processes. Section 8. The FCA's tightrope walk, balancing innovation and protection. The FCA's exploration of eased mortgage rules, contactless payment limits, and digital death certificates underscores the regulator's ongoing balancing act. On one hand, the FCA is tasked with fostering innovation, promoting competition, and ensuring that the UK's financial services industry remains globally competitive. On the other hand, it bears the weighty responsibility of protecting consumers, maintaining financial stability, and preventing a repeat of past crises. The challenge for the FCA is to find the sweet spot between these competing demands. Relaxing regulations too much could expose consumers to undue risk and undermine the stability of the financial system. However, clinging too tightly to the status quo could stifle innovation, limit access to financial services, and leave the UK trailing behind other countries in the global race for fintech supremacy. The FCA's every move is subject to intense scrutiny, with industry stakeholders, consumer groups, and politicians all vying for its attention. Striking the right balance between fostering a thriving financial services industry and safeguarding the interests of consumers is no easy feat, but it's a task that the FCA approaches with unwavering dedication. Section 9. A new dawn for UK finance, a cautious outlook. As the FCA contemplates these significant changes to the UK's financial landscape, a sense of cautious optimism hangs in the air. The potential for a more dynamic, innovative, and accessible financial services industry is undeniable. The prospect of easing the path to home ownership, embracing the convenience of digital payments, and modernizing outdated processes like bereavement claims offers a glimpse of a brighter future for UK consumers. However, the shadows of past crises loom large, serving as a stark reminder of the potential consequences of unchecked risk-taking. The FCA's challenge, and indeed the challenge for the entire financial services industry, is to learn from the mistakes of the past and chart a course towards a more sustainable and inclusive financial future. The road ahead is unlikely to be without its bumps, but by proceeding with caution, engaging in open dialogue with stakeholders, and remaining steadfast in its commitment to both innovation and consumer protection, the FCA can help usher in a new dawn for UK finance, one where growth and stability go hand in hand.